Hello everyone, introduce me to the admin of the YouTube channel about business. In this video, we will discuss about equity, which is very interesting and relevant. Have you ever wondered how equity affect a company? Let's explore together in this video. In this video, you will learn some effective strategies to understand and not go wrong in choosing the right stocks that you can implement immediately after watching. Definition of equity. Equity, in the context of finance and accounting, refers to the share of ownership in a company after deducting its debts. Equity is also known as owner's capital or own capital. Equity is one of the components in the company's balance sheet. Equity is a term used in finance and accounting to describe the amount of ownership or claims that the owners of a company have on the net assets of that company after deducting the company's liabilities. In simpler terms, equity can be thought of as the net worth or ownership value that is owned by the owners of a company. Equity consists of several components, including share capital, retained earnings, and other elements such as additional paid-in capital, employee stock options, and so on. Share capital is the amount of capital paid up by company owners or shareholders, while retained earnings are accumulated company profits from year to year that have not been distributed to shareholders. Equity reflects the level of success and sustainability of a company. Equity increases can occur through profits generated from the company's operations, increased asset values, or additional capital contributions by owners or shareholders. Conversely, losses or distribution of profits to shareholders will reduce the company's equity. Equity also has an important role in financial analysis, because it can be used as an indicator of a company's financial health. Financial ratios such as the ratio of equity to total assets or the ratio of equity to total liabilities can provide an overview of the extent to which a company utilizes its own capital compared to loans. Equity consists of several elements, including 1. Share capital represents the amount of capital paid up by the owner or shareholders of the company. Share capital reflects the contribution of the owner or investor to the company. 2. Retained earnings represents the net profit that has been accumulated since the establishment of the company. Retained earnings consist of profits not distributed to shareholders in the form of dividends. 3. Undistributed dividends, if the company has generated profits and decides to distribute part of these profits to shareholders as dividends, but the dividends have not been paid in full, then the amount of the undistributed dividends will become part of the equity. Equity reflects the net worth of a company after paying off all of its debts. Equity is a source of long-term financing for companies and is an important measure in evaluating a company's financial health. Positive equity growth indicates that the company has increased value and is able to provide benefits to its owners or shareholders. Assess equity for its good and bad. In a financial and business context, having a lot of equity can be considered a good thing. Equity is the difference between the assets and liabilities of a business entity or individual. If equity is positive, it indicates that the value of assets is greater than the value of liabilities, which can be interpreted as a higher level of wealth or the ability to pay off liabilities. A lot of equity can provide several benefits, including 1. Financial security. Greater equity provides better financial protection against risk and uncertainty. It gives a business entity or individual the ability to withstand losses or unexpected changes in financial circumstances. 2. Flexibility. With multiple equity, business entities or individuals have more choices in the use and allocation of financial resources. This could mean having sufficient capital for investment, business growth, or taking on new opportunities. 3. Borrowing ability. Sufficient equity can enhance the ability to obtain loans from financial institutions. Lending institutions tend to be more confident in providing loans to business entities or individuals with large own capital, because they have a greater interest in paying off obligations. However, too much equity can also have some negative consequences, depending on the context. For example, if a business entity has excessive equity, this could indicate that capital is not optimized and is not generating adequate returns. In addition, too much equity can also indicate that the business is not using resources efficiently or not taking advantage of existing investment opportunities. So, in general, having lots of equity can be considered a good thing because it provides financial security, flexibility, and access to additional financial resources. However, each situation needs to be assessed individually to understand its overall impact. Analyze a company's equity. Equity analysis is the process of analyzing a company's financial condition and performance with a focus on shareholder equity. Equity is the difference between company assets and company liabilities. Equity analysis provides insight into a company's value and its long-term financial health. Following are some important components in equity analysis. 1. Financial statements. Equity analysis begins by reviewing a company's financial statements, especially balance sheets, income statements, and cash flow statements. These reports provide information about a company's financial position, revenues, expenses, cash flows, and changes in equity from period to period. 2. Financial ratios. Financial ratios are used to measure the financial performance of a company and identify important trends and patterns. Some ratios that are relevant in equity analysis include profitability ratios, such as ROE, return on equity, liquidity ratios, such as current ratio and fast ratio, debt ratios, such as debt to equity ratio, and efficiency ratios, such as asset turnover ratio. 3. Revenue growth. Equity analysis also involves evaluating a company's revenue growth over time. Strong revenue growth may indicate that the company has a product or service that is in demand by the market and has the potential to provide a good return for shareholders. 4. Capital structure. The capital structure of a company is also an important consideration in equity analysis. The composition between equity and debt can affect the risks and returns for shareholders. If a company has too much debt, it can increase bankruptcy risk and reduce potential for shareholders. 5. Management performance. Equity analysis also involves assessing the quality of the company's management. Good decision-making, effective strategy and proper risk management can contribute to company growth and value. 6. External factors. External factors such as industry trends, market conditions, and regulations must also be considered in an equity analysis. Changes in these factors can have a significant impact on a company's performance and value. In equity analysis, it is important to look at the big picture and consider different factors. Comprehensive equity analysis assists investors and other stakeholders in making better decisions regarding investments and assessing company value. So, in this video we've talked about equity and explored the analysis and pros and cons of equity. Now, it's time for you to apply some of the strategies we've learned. Feel free to share the results with us in the comments section. If you enjoyed this video and want to stay updated with more interesting content, don't forget to subscribe to our channel. Thank you for watching this video and giving your attention. We really appreciate it and look forward to seeing you in future videos. If you want to explore more about equity, don't miss our related videos in the playlist available on this channel. If you found this video useful, please feel free to share it with friends or family who may also be interested in this equity. Now it's time for me to go. See you in the next video. Stay connected and take care of yourself.